Next, we have subsequent events. Let us first discuss what are the subsequent events. Subsequent events are the events or transactions that happen after the balance sheet date, but before the financial statements are issued. Let's say your balance sheet date is 31st of December 2025 and the financial statements issued date is 31st of March 2026. An event that occurs in between these two dates, let's say on 21st of January 2026. These are the events, or this event is the event that has occurred after the balance sheet date. So these events, some of these can affect the financial statements and some of them don't. So we categorize them into two main broad categories. First, recognized subsequent events and the non-recognized subsequent events. Let us discuss these one by one. First, we have the recognized subsequent event. These events, they provide additional information about the condition that already existed on the balance sheet date. Let me give you the typical example, which is almost part of this topic. Let's say we had a customer on 31st of December 2025 who owed us $15,000, and there was a serious question of recoverability because there were court proceedings and he was about to be adjudicated as insolvent, means we would almost lose everything. So what happened on, let's say, 15th of February 2026? Court gave the verdict and adjudicated him as insolvent. So now on 15th of February we learned that it's a loss. Now the point is that this condition existed on 31st of December 2025. The subsequent event, the verdict of the court, it proved that the event existed and the amount is not collectible. So what it means is that such an event for which there was a condition existing on the balance sheet date, this event must be adjusted even if it has occurred after the balance sheet date. Another example, settlement of litigation. Let's say there is a lawsuit against us currently under trial in the court of law, and it was there before the balance sheet date, but it gets settled after the balance sheet date. Right? Like we were involved in a lawsuit involving $1 million, and this lawsuit was in the court of law before the balance sheet date, and the amount $1 million was improbable. We're not sure that we will be paying. But what happened on a day between 31st of December 2025 and 31st of March 2026, this is the date when we issue the financial statement, the court decided against us. Now it's a liability. It should be reported as a liability. Similarly, loss on uncollectible receivable, I just gave you the example before that. So these are the events that require adjustment in financial statements. These two events, these conditions existed on the balance sheet date, so they require financial statement adjustment. Next class of examples we have are non-recognized subsequent events. Clearly, the name suggests that these events they do not provide any information about conditions that existed at the balance sheet date. They have happened, but there was no such condition existing on the balance sheet date that such event would occur. Sale of bonds or capital stock. Let's say the company we are preparing financial statements for, it issue new bonds or maybe sell new stocks, but after the balance sheet date. So if it happens, it doesn't affect the condition on the date and should not be recognized in the financial statement. Let's say the amount involves $2 million in bonds and these bonds were issued after the balance sheet date. This does not need to be recorded in the financial statement. Yes, but you may mention them in the notes. Business combination. Like if one company merges with another company after the balance sheet date, this event should not be recognized in the financial statement for the period. For example, a company A merges with another company B after the balance sheet date. this merger isn't recognized. Then we have settlement of litigation if the litigation arose after the balance sheet date. Like a lawsuit that began after the balance sheet date and it gets settled. So it doesn't need to be recognized in the financial statement. Like for example, a company sued in January for $5 million and it settles this liability in February. These events occurred after the balance sheet date, both of them, right? So they do not require any adjustment in financial statement. Then we have loss of plant or inventory due to fire or natural disaster. If there is such loss, building is destroyed, inventory is destroyed after the balance sheet date, since there was no such condition existing on the balance sheet date, so such events do not require any adjustment. However, you may disclose, but they do not require any adjustment to financial statement. Like for example, a company's warehouse was destroyed on 15th of January and it lost maybe $2 million worth of stock which was uninsured. So this event was nowhere in present in 31st December. So it should not be recognized in financial statement. However, notes, we can use notes to explain this event, or maybe we can use notes to mention such event. Changes in the fair value of assets, liabilities, or foreign exchange rates. Well, if the value of foreign exchange changes after December 31st, the impact of this change is not recognized. If value of any asset or liability, fair value changes after the balance sheet date, it is not recognized. Then we have entering into a significant commitment or contingent liability. If a company agrees to a significant contract or a liability after the balance sheet date, this isn't recognized in the financial statements. Let's say a company signs a major contract in January, clearly after the balance sheet date. This commitment is not reflected in December 31st financial statements. Loss on receivables resulting from conditions occurring after the balance sheet date. Like if a customer defaults on payment due to events after the balance sheet date, on the balance sheet everything was fine. Let's say we had a customer X, and on 31st of December 2025 his financial strength was fine. He was perfectly solvent. But what happened on maybe 15th of January, there was a massive loss at his factory because of fire or flood or earthquake maybe, and because of this eventuality he is in trouble, and maybe the amount that we had to collect from him may not be collectible. So if this amount actually becomes bad, uncollectible, maybe by 31st of January 2026, this is not adjustable or not recognized because such condition did not exist on the balance sheet date. His solvency was affected after the balance sheet date. There was no such doubt, so it's non-adjusting. Subsequent event evaluation period. It's the time frame during which the company must evaluate events that happen after the balance sheet date to determine if they should be recognized or they should not be. Let us break it down into some simple forms. Let's say, first of all, there are two types of entities. Those that file with SEC, that is SEC filers, and second, it doesn't. Under the law, it's not required to file financial statement. If the company is a filer, SEC filer, then the company must evaluate the subsequent event until the date the financial statements are actually issued. Let's say 31st of March 2026, right? Like if a company files its financial statement with SEC on 31st of March, they need to consider any significant event that happened between the balance sheet date 2025 and 31st March 2026. What about non-SEC filers? Companies that do not file with the SEC, they must evaluate this subsequent event until date the financial statements are available to be issued. For example, if a company finalizes financial statement on 15th of February 2026, whereas the balance sheet date is 31st of December 2025. So remember, financial statements are finalized on 15th of February, but they are issued on 1st of March 2026. So now in this case, the company must evaluate events up to until 15th February only and disclose in financial statements. Reissuance of financial statement. Let's say a company has issued its financial statement 31st of March 2026, let's say. Okay. Then they reissue their financial statements on 15th of April 2026. Why would they do that? Because maybe they need these financial statements to be shared with new shareholders, or maybe due to certain regulatory requirements. So when reissuing such financial statement, the company should not include or recognize any event that has occurred between these two dates, unless if it is required by the regulatory body, SEC, or it is required by the US GAAP. This is an important point, and please pay special attention to this part. Next, revised financial statement. Let's say company issued its financial statements on 31st of March 2026, but then they had to change or update something and publish revised financial statements on, let's say, 18th of April 2026. Now, why would you do that? This usually happens if an error was found in the original statements, or maybe the company needs to apply an accounting change retrospectively. So these revised financial statements are treated as reissued financial statements. Here we have some examples of subsequent events. Friends of Fido is an SEC filer and has a balance sheet date of December 31st, year 3. The entity will file financial statements by the end of March, year 4. The following events occurred after the balance sheet date. A lawsuit filed in year 2 was settled in earlier February. Friends of Fido must pay $600,000 as a result of the lawsuit. The financial statements currently reflect a contingency amount of $725,000. Now, in this situation, the event that we discuss here, it existed as of December 31st, 2003 or year 3. So this condition was there. Since the settlement amount for the legal contingency has been finalized after the balance sheet date, but the condition already existed, so the financial statement should be adjusted to reflect the actual settlement of $600,000. So this is an adjusting event because the condition existed on the balance sheet date. Second, the entity announced in early March that it will acquire Doghouse Incorporated for $1.5 million. It occurred in March after the balance sheet date, and no such condition existed on the balance sheet date, non-adjusting. The acquisition, which is planned for September year 4, will be made with cash in stock. See, the planned acquisition is taking place after the balance sheet date. It is not finalized by December 31st. Since the acquisition is not yet finalized on the balance sheet date, it's a non-adjusting event or non-recognized subsequent event. Next, we have a customer that had a significant aged invoices at year end. Condition existed on the balance sheet and announced bankruptcy in January. It is a recognized adjusting event because condition existed on the balance sheet. A second customer that is typically a timely payer had multiple outstanding invoices at the year end. The customer experienced a flood in February and the entire retail location was wiped out. The customer has decided to close its business permanently and is not returning phone calls regarding payment. There was no condition on the balance sheet date regarding this flooding, so it is non-adjusting. It is non-recognized subsequent event. However, if the amount is significant, then it may be disclosed in notes, otherwise not. So this is a non-adjusting event.